Today we're analyzing a top shoe manufacturer's stock. We'll quickly navigate through its company history, profitability, current valuation, and forecasted returns. This compact yet thorough analysis is designed to give investors a clear view of its potential in the dynamic footwear market. Let's dive in and uncover the investment opportunities this stock presents. Hey friends, welcome back to the channel. If you are new here, I'm Cody Koch, a 25-year veteran investor, former hedge fund trader, and business owner. And on my channel, I like to make my viewers money by bringing them investment ideas like this one. Okay, so today I'm going to talk about a shoe company called Crocs. Chances are you've heard of them before, symbol CROX. Okay, so Crocs, together with subsidiaries, it designs, develops, and manufactures, markets, distributes lifestyle footwear and accessories for men, women, and children all over the world. It offers a variety of footwear products such as clogs, sandals, slides, flips, wedges, platform shoes, socks, boots, shoe charms, slippers, all under its Crocs brand name. They sell their products in approximately 85 countries. They sell through wholesalers, retailers, e-commerce companies, and third-party marketplaces. The company was founded in 1999 and it's headquartered in Colorado. Okay, so you might be a little bit curious about the history of how this company got started. Crocs was founded by three friends, Scott Siemens, Lyndon Hansen, and George Bodecker Jr. They really enjoyed boating. While in the Caribbean, they came across a new shoe design from a company called Foam Creations, and it looked very similar to the Crocs you recognize today, particularly designed for people who enjoyed boating. The fact you constantly have to deal with water. They wanted the shoes to be able to float and so forth. The three friends decided this was a great idea and they decided to go into business, and early in the 2000s, they bought Foam Creations. Funny side note, Crocs was actually featured in the movie Idiocracy back in 2006 because the costume designers in the movie had decided Crocs was such an ugly, unattractive shoe, but it was so cheap that they could buy these shoes for the entire cast and remain under budget, at the same time fitting the theme of the movie in which humanity had digressed dramatically in terms of intelligence and had decided crazily to wear these ugly shoes. Now, all of that said, Crocs has almost a cult-like following because they are known to be so well made and are so comfortable to wear. Okay, so how I found this stock. I started off by ranking all stocks based upon their earnings yield. Stocks with the highest earnings yield got the best rankings. And then I ranked all stocks by their return on invested capital. Stocks with the highest return on invested capital had the highest rankings. I then combined these two rankings, and stocks that overall ranked the highest with the combination of the two were displayed, and through that I picked through them and picked a handful of stocks that I really decided I liked, and Crocs was one of them. Stocks that rank the highest on this criteria on average have returned 15 to 20% per year since the 1970s. Next, let's get into the financial information of the company. So you can see here revenues from 2018 till today have steadily increased. Estimates for the end of 2023 and all of 2024 show a bit of growth as well. The earnings per share follows the exact same pattern. Estimates for 2023 and 2024 are showing notable growth. Earnings per share in 2024 for the company estimated to be about $12 per share. Quick glance at its income statement, you can see revenues have significantly grown from about $1.2 billion up to about $4 billion today. Net income was a little bit negative a number of years ago, but in the last 5 or 6 years, it started to turn around and grow significantly. Same with earnings per share. All right, so Crocs' balance sheet, you can see here, they have about $127 million in cash. You can see kind of the pattern in their cash over the years. We'll scroll down and look at its total assets. They have about $4.6 billion in assets, steady increase there. As you can see here, Crocs' total debt has increased dramatically over the last few years, and the reason it has is because Crocs acquired the company Hey Dude in an acquisition recently in the last few years. We will discuss that acquisition in a little bit. Common equity is about $1.2 billion. Its financial statements are in pretty good working order, except for that large amount of debt, which we will discuss in a little bit. Crocs' profitability is actually very good relative to its industry. Out of 36 footwear companies, Crocs has the second highest return on total capital. It has excellent return on equity. It also has very good margins relative to its industry. You can see here its PE ratio is around 7 to 8 times earnings, which is actually quite cheap relative to both its sector as well as to Crocs itself. Crocs on average has held about a 16, 17 times earnings over the last 5 years. It is less than half the PE ratio as it once was. That means there's a fairly good chance Crocs can double in price from where it's at now. We'll also go to EV versus EBIT, or enterprise value versus the earnings before interest and taxes, also known as the acquirer's multiple. This would mean if we went in there and bought the whole company, paid off all of its debt, paid back the cash the company has in its coffers to ourselves, it would cost us about 7.5 times its current earnings of the company, which means we could get all of our money back within about 7.5 years after acquiring Crocs at its current price. For large publicly traded companies, that's actually pretty good. What's also notable is that Crocs had, over the last 5 years, on average, an acquirer's multiple around 16 times earnings, which means that Crocs could possibly double from its current price to get back to its historical average acquirer's multiple. You can see here the PE ratio of Crocs relative to its industry peers. You can see Crocs has got the third lowest PE ratio relative relative to its peers of the entire industry, which means it's pretty undervalued. Now let's check out the enterprise value relative to EBITDA. You can see Crocs is probably in the bottom 1/3 of its industry in terms of the lowest acquires multiple, the lower the better. And so overall, Crocs, considering it's quite profitable and it's quite undervalued by several measures, it looks like it's got a lot of opportunity to potentially rise quite dramatically. All right, the stock over the last 5 years, stock price itself, you can see 5 years ago it was approximately $25 per share. At one point it rose up to $180 per share, got back down to about $50 per share, and at the moment it's around $91 per share. It's kind of whipping all over the place quite dramatically. You can see that overall the stock's up about 240% over the last 5 years, but in my opinion it still has quite a ways to go, simply because they have so much potential in the company. They've got a lot of profitability at the moment. If it holds up at all at its current valuation, there's a really good chance you're going to make a pretty good return on your money. Now let's talk about the major risks for Crocs. The first major risk is that footwear and clothing industry in general are quite sensitive to economic instability. Also, they're very sensitive to shifts in consumer demand. Things can dramatically go in and out of fashion very quickly, and so that is naturally a concern for companies like Crocs. The second major risk for Crocs is the poor performance of the company they acquired, Hey Dude, a few years ago. Hey Dude has had weak orders and also been hampered by discounts and promotions they had run, which notably lowered the average selling price. Management of Hey Dude believes everything will work itself out soon. Things should return back to growth later, but it is a concern the market is talking about. As a quick side note, Hey Dude sells shoes, although they're notably different looking than Crocs, but they do sell shoes, and this can actually, in my opinion, dramatically in the long run, diversify away Crocs' risk around their particular design of shoe. This should lower the dangers of a fashion shift putting Crocs out of business. So how the company can potentially fix its problems. So the way the company plans on lowering its risks. The first thing they're doing is they're deleveraging after their Hey Dude acquisition. They're significantly paying down the debt they took on to buy Hey Dude, allowing them time to digest and lower their interest expense and so forth, increasing their cash flow. The next major thing the company's decided to focus on is direct-to-consumer selling. In the past, they haven't focused as much on that. About half of their sales come from direct-to-consumer sales. They've decided they want to focus more on that because it gives them an average price that's notably higher than if they sell through wholesalers and direct-to-retailers. So their thinking is as they focus more on direct-to-consumer, they can get a notably higher profit margin on their shoes. Lastly, the acquisition of Hey Dude, although it's been sketchy so far, is a sign the company is looking to expand their product lines into other areas, both in footwear and outside of footwear, so that they are less concentrated around their particular design of shoe, which can be, of course, risky if fashion trends shift too quickly. If the company is able to diversify and be less concentrated, then they can significantly increase the chances that stability in its earnings will continue into the future. Now, as a side note, I would like to say this. Crocs, ironically, have been considered one of the ugliest shoes on the market for many years. And despite that, the company continues to grow. I personally have never worn a Crocs. I know very few people who've even attempted to. The one I do know actually loves them, and he wasn't a fan of them prior to that. They're so comfortable that he's decided he enjoys the shoes and owns a few pairs himself. I believe there's a chance that Crocs, despite being a relatively unattractive shoe and a bit of a joke in a way, actually has a bit of a cult-like following because there's many people who just absolutely love the shoe because they're so comfortable, they're so well made, and they're so useful in a variety of circumstances. So ironically, despite that headwind of negativity towards the shoe, the company's continued to grow. In my opinion, that actually means it has a decent amount of staying power going into the future. All right, next let's do a scenario analysis to gain our expected returns on the Crocs stock. Okay, so as of this recording, the stock is selling around $91 per share. So I'm gonna start off with my normal analysis, and I'm gonna start off with the worst case scenario like I always do. There's an old saying, look down first, not up, when it comes to investment analysis, and that means you wanna look at your risks first. So the first thing I'm gonna estimate is that we have about a 5% chance of the company going completely bankrupt. Stock's going to zero. Now, I don't believe it's actually 5%. I'm being conservative here. I'm assuming it's a way higher chance of it actually occurring than it really is. I'm gonna estimate there's about a 15% chance that Crocs could fall from its current position by about 50% down to approximately $46 per share. The reason I throw that in is because I've just been around the block a long time. All kinds of things can happen. It's very possible the stock market may crash and cut the stock in half. It could be the company starts to get in a little bit of a trouble. Maybe fashion trends shift too far away from Crocs. The company gets in a little bit of trouble, something like that. So there's always a possibility the stock will fall by about 50%. Next, there's a 30% chance that the stock will fall by about 20%. This is roughly what I'm estimating, is because stocks typically swing all over the place, and there's a fairly good chance it could fall by 20% and just never really go back up. Who knows? Anything can happen in that scenario. Next, I'm going to estimate the stock has a 30% chance of going up by 50%, that some of my investment thesis comes true. That would put the stock at around $137 per share. Lastly, I think there's about a 20% chance the stock could possibly double from its current price, get back to those multiples that we see see in its industry and also its historical multiples it had on average over the last 5 years. That's quite an easy thing for Crocs to possibly get back to. That would put it around $182 per share, which it isn't outside the realm of possibility considering this company actually reached $180 per share in the last 5 years with substantially less profit in sales at that time than it has today. It's quite possible the stock can get there from here. Put all these statistics into some algebra and the average return I expect this stock to produce is around a 16.5% return over the next year or so. Next, let's talk about risk management, which is an incredibly important topic. For publicly traded stocks, there's only 3 ways to manage risk properly. The first is to use some sort of stop loss for that stock, and in this case, it will not work for this type of investment. The second way is to use some sort of options contract, like put options or some variations of call options, various things. In this case, this is not designed for that kind of risk management. And the third option is to use position sizing, which you should always use position sizing no matter what you're doing. It's one of the most important forms of risk management. So in this case, position sizing is what we're going to use, and I would recommend purchasing no more than 5 to 10% of your total portfolio of this stock. So that means if you have a $1,000 portfolio, do not put more than $50 or $100 in this stock. If you have a $100,000 portfolio, don't put any more than $5,000 or $10,000 into this single stock. I definitely wouldn't go above 10%. Now, it is very important, of course, to have an exit strategy. In this case, I recommend the exit strategy is you buy it and hold it for a little bit past 1 full year. The reason for that, of course, is you get capital gains taxes and also gives it time for the investment to mature and the investment thesis to come true. Typically, the longer you own these investments, the better their performance for at least 1 to 3 years after you buy it. In some cases, longer. After that year is up, you can reanalyze Crocs and see what its potential is going forward and reevaluate at that time and see if you want to hold on to the stock or sell it. Next is trade execution, which are pretty costly. You got to be very careful with them. The bid-ask spread is very important, as well as slippage. So to protect yourself, I would recommend you have one of 2 options. So I'd either recommend a buy on close order or a limit to buy on close order. That way you can just go ahead and get in and not worry about it too much. If on the other hand, you're more worried about slippage, you can go ahead and put a limit to buy order below the prevailing bid. Just leave it there for a couple of days or a week or so. 90+% of the time, the stock will get filled at that price and you will actually save yourself the bid-ask spread there. The bid-ask spread costs about 0.5% to a full percentage point on your investment, which adds up quite a bit over time. So using this trade technique helps save that bid-ask spread. Next, as for management of your psychology, I always recommend a calendar alert on your phone from the point you bought it to a little bit past 1 full year from when you bought the stock. In the meantime, do not pay attention to the stock. Do not look at it. It's kind of stressful. Even if it makes a lot of money, it's going to be stressful because you're going to want to sell it. If it crashes down to nothing, you're going to be upset. You may want to sell it. Just don't pay attention to it for a full year. It helps manage your psychology quite a bit. So in this video, I did a deep dive on the stock of Crocs, but previously I did a deep dive into a very undervalued toy company called Jakks Pacific. You can watch that video here. If you would like to continue to get investment ideas like this, please hit that like button and subscribe, and I will see you in the next video.